All right, good afternoon, everybody. What it was, cuz whew, I'm losing it, losing it. All right, what a crazy day. I bet the S&P closed like unchanged or something. I don't even know where we closed, but what a crazy day. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer. And member of FINRA SIPC, all of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. I added a short in hymns today. I got out of, I was long like a dollar stock. It was lottery.com, SEGG. I got out of that today when it slid back below a dollar. All right. Uh, So I'm just trying to see. So we're down like 60 cents after hours. So we did close red today. So we're down like 60 cents after hours. We're down 0.4% in the SPYs. So we probably closed down like a 0.25% or something like that on the actual day. So nothing dramatic, though it felt like the sky was falling at a certain point in today's trading session. We still don't even have a full even negative half a percentage point close in the S&P. The Nasdaq closed red. That looks like a day to take notice of, that daily candle. We'll circle back to that in a second. So Nasdaq closed red. It's trading a dollar plus down after hours as Amazon is starting to trade lower. We can take a look at that report together in a second. The IWM down 0.9%, TLT flat, the dollar up another 0.25%. Oh, thank you. The S&P closed down 0.37%. Okay. Okay. Is that an increase in realized vol compared to what we're used to recently? It may just be. Um, U.S. Commerce Secretary Lutnick on Canada trade talks, 35%. That letter he sent is surely in the cards. Okay. Okay. At some point this might matter to the market. Uh we're at our August 1st deadline tomorrow. I don't know if that matters anymore, but I don't know. Some of this language that's coming out might matter at a certain point. But let's just focus on the technicals and what happened between yesterday afternoon and today's close, because it has been a wild, wild ride. So this is a day to take notice of in the spies. Can't help but wonder what that candle would look like if you still didn't have Microsoft and Meta as green as they are. On a percentage basis, they're still up a lot. I know that they're both closed off their highs. Microsoft really sold down. We actually predicted that in the morning meeting pretty well. But yeah, spies here giving us kind of a day to take notice of, gapping up to new all-time highs because of Meta and Microsoft, closing on lows, engulfing one, two, three, four, five, like 6 trading sessions worth of price action in one day, and appearing to give us our first close below the ADMA on the daily chart, unless it's happening after hours, since over a month, since June 23rd. Look at that selling. Look at that selling. What a big sell-off from 640 down to 632 after we had a rally from 480 to 640. So just incredible, incredible lower. I'm saying this with as much sarcasm as I possibly can. The cues here, though, also giving us a little bit of a day to take notice of. A little bit of a bearish engulfing candle. Look at the volume pick up. And again, that's with Meta still Meta still closed up 11% on the day. More, I think. Microsoft still closed up 4 or 5% on the day. And we got this bearish engulfing candle from the cues, gapping up to new all-time highs and trading through like 6 days worth of price action, giving us a close, I think, just below the ADMA on the daily chart for the first time in over a month. This market has not seen a downtick in 2.5 months, basically. But first real close below that ADMA. And I think it looks like it's gonna lead to more. Unless Apple and Amazon save us, Amazon doesn't look like it's gonna be good enough. We'll see what happens with Apple in 15 minutes. And then we got the big non-farm payrolls number tomorrow. But We've been remarking here as a team that the price action these last handful of trading sessions looks like distribution. And this is like the most traditional thing in terms of trading and trading cycles. If anyone remembers, you can just Google this simply if you don't know it. You can find a very basic chart that shows you like how market cycles work. They work in 4 cycles. They work in an accumulation phase, which is oftentimes referred to as a base, where the market breaks up off that base and goes into like an uptrend cycle. And then at the end of that uptrend cycle, you get a distribution phase. Traditionally, the distribution phase of the market is when the smart institutional sellers are selling to the dumb retail money. I would argue that that traditional part of that cycle may have changed a little bit in terms of the nature of the buyers and sellers. But if this is a distribution cycle that we're in, interestingly enough, that's what the data right now has been showing. The data has been showing that the last week or so, the hedge fund money, which we used to consider to be the smart money, have been sellers. There's been outflows coming from them as retail continues to buy. Though I did see a chart this morning that showed that retail actually bought less than their 1 year average or whatever in this last week. So they might be buying a little bit less now also, because I don't think that retail is as dumb of money in aggregate as it used to be. But yeah, we appear to be in some sort of a distribution cycle, negative Maribozu engulfing candle here on the Qs. And then the IWM and the RSP, they already were looking like in the morning meeting like they were set to break down after the Fed and after Jerome Powell yesterday, right? That was the whole kind of crux of the morning meeting today. Is we were looking at a pre-market daily chart of the RSP and the IWM that looked ready for a breakdown, whereas the pre-market daily chart of the SPY and the Qs looked like they were going to be a potential day one breakout to the upside for the market. And the question that we were asking ourselves is, well, what's going to win here? Will the weakness in that RSP, the weakness in the IWM, carry us through down? If that's going to happen, we said that you probably need to see profit taking coming into Microsoft and into Meta. And we also, again, we noted in the morning meeting, which I kind of only literally remembered this as I was talking about it in the morning meeting, but it turned out to be, I think, pretty good information. Microsoft has a history, from my personal anecdotal experience, of gapping up on good earnings reports and selling down on them. There's a few companies that do that. SoFi, I feel like, always does that. Very different company than Microsoft, but it's always kind of been the profile of Microsoft as a stock, where you get these good reports that gap up big on it, the profit taking comes in, and then it closes poorly. Even the last earnings report that it had back here on May 1st, it closed on lows that day. Notably, that was like the only red day over the course of the entire quarter, pretty much for the entirety of Microsoft, which is really impressive. But even that day, which triggered this huge uptrend, they closed it on lows. So we were saying like everything doesn't look good right now in this market except Meta and Microsoft, because their earnings reports weren't good; they were phenomenal, and Nvidia and AMD, because they're up huge off of Microsoft saying that they're going to be spending $30 billion a quarter, which is more than expected on CapEx. And we all know that that is money that's going directly into the pockets of primarily Nvidia. At the same time, another interesting piece of the puzzle when it came to semiconductors is that we had AMAT and ARM report, and both those reports were not phenomenal when the stocks were trading down. So when I was doing the morning meeting this morning, I was looking at Nvidia up huge and AMD up huge, but AMAT down huge and ARM down huge, and the semiconductor ETF pretty much like flat or very small red. So it was quite the interesting puzzle that we were trying to put together this morning to figure out what the price action was going to be. And the biggest answer to that puzzle was going to be, how does the market handle basically those leaders, those handful of leaders, Microsoft, Meta on the earnings reports, and AMD and Nvidia that were almost trading as secondaries to those earnings reports? Will profit taking come in and they'll sell down, in which case the weakness in the RSP and the IWM will probably actually carry us through lower? Or is it day one breakout for the SPYs and Qs. Doesn't matter that it's poor breath because those four companies, Nvidia, Microsoft, Meta, AMD, just have such large market caps that in and of itself could be enough. The chase is on and we break up and continue. Well, now at the end of the day, we have our answer. And the answer is Microsoft still closed up 5%. Meta still closed up 11, 12%. Yet they closed off highs. We did see profit taking. We did see Nvidia go red during the day, though the chart is by no means broken. We did see AMD, which had basically gone parabolic, go red during the day. And you're left with a bearish engulfing in the SPYs and a bearish engulfing in the Qs. And the IWM and the RSP really looking pretty bad at this point. The RSP closed down 0.9% on the day. So this market looks like it is finally set to me for lower. I've been saying that for the last couple trading sessions, and it's actually been happening, albeit it's like the opposite of June, right? In early June, it seemed like we kept having bad news, but the market couldn't go down. Here we are in July, and or I guess the very, very end of July, as we're starting to go into a period of seasonal weakness, where it's almost seems like we keep getting good news, but the market has not been able to move higher, right? When it comes to the tariff talks, deals with the EU, um, and then again, obviously on the micro, just Meta and Microsoft, those two earnings reports were some of the most phenomenal earnings reports I've ever seen. And it was so frustrating yesterday when, after Jerome Powell, the market finally looks like it's ready to break and move lower, just to get completely saved by Meta and Microsoft, and then have Nvidia trading up huge in the after hours as a result. And then the selling came. So I'm really curious to see if this bearish engulfing data take notice of in the SPYs, which is also on higher volume, same thing with the Qs, actually leads to some follow through to the downside as it's happening in conjunction with tomorrow is August 1st, Friday, August 1st, where we begin to go into a period of seasonal weakness. The first 2 weeks of August are traditionally known for having outflows from the market. With that said, we'll be cushioned a little bit by the corporate buyback coming into play. But then that leads to September, which I believe is historically the weakest month of the calendar year. So it's going to continue to be an interesting one. But when I'm looking at this daily candle, I see the first victory for bears that I have seen since April. Like literally nothing when you look at this daily chart. Like maybe we had like one day here in June where we closed on lows that was immediately negated the next day on that June OPEX day, basically. But there has not been a single day since April, since that huge crash that the market had, that has been a win for the Bears. And we know why. We know why. It goes back to my half joke about the afternoon meeting that I did a day or two ago, where I joked and I said trading is easy. Because all you got to do is follow the flow. That's what matters. That's what matters more than the news, the technicals, literally anything. We want to pay attention to all that stuff. It's important, but you need that bad news to occur when the market dynamics are lined up for selling to actually be able to occur. And we have not been in that situation until more or less now. So we'll see. This is an interesting daily candle. We're about to see Apple come out with their earnings report here in 4 minutes. That's still a really important company. It's going to be an interesting report because Apple is going into this report with, I think, like a lower positioning score than any of these other Mag 7 stocks. So, like when you look at this Amazon report, the report, I think, and I haven't really looked at it with everybody, I think the Amazon report is good, but similar to a bunch of other earnings reports this season, good is not good enough, and they're selling it down. Apple might be a situation that's a little bit different, where if a report's just a good report, it might move higher because it's been weaker and because the positioning has not been in play. But what would happen if we actually have news with Apple or with non-farm payrolls tomorrow morning that doesn't save the market like always seems to happen, but actually continues the weakness that we saw today? And again, we only closed down like 0.4% in the S&P. This is not a sell-off day. I still don't think we've had like a 1% down day in months or anything like that. But when you finally get a candle that's a day to take notice of, when you're finally getting a little bit of an adjustment in these market dynamics that aren't necessarily bearish, but they're significantly less bullish, if you could actually get some bad news to hit at the same time that could act as a catalyst, all of a sudden, maybe bears might be onto something. And we got two pretty big events, one in 3 minutes and one tomorrow morning. So that's pretty much where we're at. Let's take a quick look at this Amazon report. This number is here. Amazon sees third quarter net sales. That's a guidance as a nice little beat. Second quarter operating margin beats, net sales beat. AWS looks like it's in line. Operating income beats, net sales beats, EPS beats, physical stores. I don't think anybody cares about that, but it beats. AWS beats. North America net sales beats. Every number I just said on Amazon is a beat. Every single one, except one is in line with AWS, and that's an important number. But every number is a beat. It's just not it's not that crazy degree of a beat that we saw with Meta and Microsoft. And it's really notable that as I just read out beat for Amazon, that stock is trading down $10 now from its intraday high. Less than that from where it actually closed. Oh no, it's trading down $9 from where it closed. So I think that that's the cycle that this market's in. And if you just didn't get the most phenomenal earnings reports ever from Meta and Microsoft, imagine what the daily chart on the SPYs and Qs would look like from today's trading session if Amazon and if Meta and Microsoft were just down as much as the Qs. They were down even just if they were flat on the day. Imagine what the QQQ candle would look like on the day. And I also agree with what Josh is saying. After what Microsoft did with Azure, probably a lot of strong expectations were priced in the market for the AWS number, and you can't just be reporting in line. I guess that's the downside of being the company that reports less after, I should say. Yep, so we got Apple here that's about to report in 45 seconds. Traditionally, I used to not do afternoon meetings on Apple Day because I would be trading it. Not really planning on trading Apple today. Just got too much going on. But let's take a look at what happens here with Apple as a team as we see these numbers come out. 30 seconds. I'm happy to talk about some of my other trading that I did today. Happy to talk about any questions that you guys might have. But let's see here. Apple, 20 seconds. It is about to hit. What do you got for us, Mr. Tim Apple? Are you going to save the day? Are you going to save the market? 5 seconds. And Apple immediately is ticking up. Apple immediately ticking up $6 here. Not seeing the numbers yet. Thanks, Bill. EPS beats. Third quarter revenue beats. Greater China, that's an important one, beats by a little bit. Wearables, small miss. iPhone revenue is a nice beat. A $4.5 billion beat on iPhone revenue. Products revenue is a beat. Operational expenses is a small beat. That's not a good one though. And it's coming back down here a little bit. iPad revenue is a miss. Mac revenue is a beat. Tim Cook said company estimates purchases ahead of tariffs drove 1 percentage point of nearly 10% sales growth in fiscal third quarter. You got to wonder how much of this last earnings reports from all these companies are being boosted further by people front-running tariffs. Tim Cook says companies saw some evidence of consumers pulling purchases forward amid tariff announcements in fiscal third quarter. So those beats that I just read out loud for Apple, if they're being attributed to purchases being pulled forward because people are trying to jump ahead of tariffs, that would be bad for forward numbers potentially. So Apple is trading up still. It pulled back off of its high, but Apple is still trading up a few dollars. From what I'm seeing here, this is not going to be enough to save the market after our weekday today, but it certainly doesn't hurt it. It certainly doesn't hurt it. So we're going to turn things over to non-farm payrolls tomorrow morning as the most important thing. All right, so we'll keep an eye on this Apple. I'm not really planning on trading it. The conference call is probably going to be at 5 o'clock. The price action looks a little bit sloppy here. The numbers for both Amazon and Apple are pretty much beats across the board. Not enough for Amazon. Seems to be enough for Apple, but not, we're not up huge on Apple. I forget what Apple was pricing in. I know Josh posted it in the VTF right into the close. Let me scroll up and see if I can find it. There it is. Apple pricing in $9 move, and currently Apple is trading up like 5. So trading less than the move. Amazon was pricing in 13, and Amazon is trading down 8 because numbers were good. Reddit came out after hours, and Reddit crushed it. Reddit's up huge. Reddit was pricing in 21, and it's currently up 24, 24 and a half. I'm a big bull on this Reddit. Been saying that one for a while. Great company. I think they have so much potential for growth in terms of their advertising and everything. They're only at the infancy stage compared to what this company could, I think, can build out. Um, Apple Board of Directors has declared a cash dividend of 26 cents per share. Today, Apple is proud to report a June quarter revenue record with double-digit growth in iPhone, Mac, and services, and growth around the world in every geographic segment. At WWDC 25, we were excited to introduce a beautiful new software design. Okay. All right, so Apple and Reddit trying to help the market a little bit after today's week close. Amazon doing the opposite. So we'll see how all this settles tomorrow morning after we get through non-farm payrolls. Let me see. Anything else on today? Today was just a crazy day. I was so focused on semiconductors this morning and watching them sell in the beginning of the day. A lot of things sold hard in the beginning of the day, but watching them kind of hold gap fills or hold their ADMA on the 5 minute and give really big bounces. I mean, this AMD eventually made new highs on the day before closing a little bit weaker. Uh, Hold on, that was Amazon. uh, yeah, it didn't. I knew that was right. It did not make new highs on the day. AMD filled the gap, overshot it. I remember talking about 179, and AMD is a really important spot. If it could start to get below it and hold above it, they tailed it right back up. It went after highs, but did not break highs. And then it wasn't until the afternoon session that it really lost that 179. So AMD here at the end of the day has an interesting daily candle. It seems to satisfy some of the upside extension, that parabolic move that the stock was having. I think that there's more room to the downside in AMD, especially if we can get any market help. I think this thing could see between 160 and 165. Nvidia had every reason to go and continue today. Was not nearly as extended as AMD. Was not nearly as parabolic as AMD. Is the biggest, I think, beneficiary of the Microsoft CapEx spending. They gapped it up big. They closed it on lows. It's not a bearish engulfing. It's not below the ADMA on the daily, but it is notable that they sold this thing off on good news. It's like the first time that's been able to happen, and we'll see if that can get some fall through to the downside along with the market. So that was certainly a focus for me. Palantir ticked up, I think, to new all-time highs today, real quick. And then shot right back down, lost that 160. I'm still looking at the low end of this wedge for a break lower. I still like the idea of adding Palantir short, or from some people maybe starting a new grade on Palantir short if this wedge breaks down with the help of the market, with everything else that we've been discussing, the extra competition for the name, and the incredible PE that the thing is actually trading on. We had a great call out in the morning meeting for Tesla short through 318. Ended up working great. Tesla rolled over like $10 from that spot, so it was a really, really solid trade there. And then we had a really good call during the day today. I didn't even realize that Hims was on a day 3. Hims got super, super extended, broke these recent highs, pretty much was going after its all-time high, and then but it's a day 3. And look at this, it went parabolic on the 5-minute chart on a day 3 on the daily. That's why we go big picture down to small picture. I don't love this short for anything more than a retracement to the ADMA when I'm looking at the 5-minute. When I'm looking at the daily chart, I love it for a potential reversal on the 5-minute to give a retracement on the daily. So I communicated when this thing got above 70 that I was putting a sell stop at 70 to short it on the way down, not on the way up. And it triggered, it went through that 70 and was really trying to hold that ADMA for a while before it eventually rolled down. I'm looking for a move to just 65 on this. Could certainly be more greedy. The ADMA is all the way down at 60. I might actually get market help on it as well, but just looking for a move to 65. So I probably have less than a quarter of my position. No, well less than. I probably have an eighth of my position, or even a little bit less than an eighth of my position with it trading at 65.50 right now. It's almost at my target actually. Trades a little bit lower this afternoon. I'll be out. So that's all I got for you guys. What's Apple doing? Apple only up $3 now at this point. Happy to take a look at any questions you guys might have. From Liam, with Reddit gapping up this morning, do you think that was just institutions front running good earnings? No, I don't think so at all. I don't think that institutions have any idea what they're going to report ahead of time. I think that Reddit gapped up because it was a really interesting open this morning because the IWM was gapping down, but the Qs were gapping up huge, and most of like the speculative names were gapping up. Like Hims was moving higher, the crypto names were moving higher. Um, those like obviously Microsoft, Meta, AMD, Nvidia were moving higher, but I'm not surprised to see that Reddit was gapping up. Oh, and also I'll tell you really why Reddit was gapping up. It was gapping up because of Meta, right? Meta's report was huge. Reddit is also a social media company. So it's gapping up as a secondary offer, as like a secondary, not offering, as a secondary play to Meta. Not, I don't think it has anything to do with front running of earnings. For Mike Reed, do you think that we haven't really seen the market reaction of the new 15 to 20% tariff baseline yet? That is my opinion. Um, we've talked about this a few times over the course of the last couple of months on how the market has evolved here with the tariff situation. And especially when you realize that most people who are market participants, let alone the people that just like to rant and rave about politics but don't follow markets at all, um, like how they have been seeing the market in relation to tariffs, right? Like what we know because we're a little more educated is the bear market that we had, which was not a bear market because we went down 19.5% in March and April, was an event driven bear market, right? And then you have this huge, huge, huge rally here, like a historic rally. But the rally is a positioning rally more than anything, right? And when it comes to bear markets, we learn from those wonderful Goldman notes that there's three types of bear markets: event driven, secular, and secular. So the big question has been, will the event driven market turn into a cyclical uh, bear market? And the difference is this is just fear of the event. It's shock and awe of the event of, oh my God, I can't believe Donald Trump came out with that, big beautiful piece of paper with all the huge amounts of tariffs on them that weren't even based on math. That was the freak out implosion to the market. But him coming out and saying tariffs or saying something that might impact the economy is not going to impact the economy tomorrow. And especially because he gave everybody a month or 2 months or 90 days or whatever. And companies are smart. The one thing I'm always going to give credit to are companies. I mean, we're seeing it right now with Apple's report that, both people and companies are front running tariffs. People were building up inventory ahead of time. So then what we got was this huge positioning squeeze here for the market, right? Go back and look at the CTA data and the vol control data as you see it now. I just read that morning note from Pat like yesterday or whatever to everybody that showed that the vol control bid in the market is usually like an escalator. And I don't remember which analyst I was reading who said it this way. But basically, what that analyst said was in studying of the vol control bid, that chart, usually that bid is like an escalator. This was like a trampoline. It was like when you look at that chart of that bid, it is just vertical up as we saw realized vol come back down, CTAs buy, markets work in feedback cycles. All this is here, in my opinion, is a 3.5 month positioning squeeze where you are going from net short on systematics to max long exposure in a wild feedback cycle in an environment where you are not seeing virtually any impact of tariffs in the economy yet because it takes time. This is what Jerome Powell keeps saying. It takes time for it to work its way through the economy, especially when smart executives at S&P 500 companies are using that as an opportunity to store up as much inventory as they possibly can to get ahead of the the tariff problem, right? So and now circle back to Pat's note this morning, that Goldman portion of it, which I highlighted twice today because I think that this is really interesting, right? Um, this Goldman note could not have summed up yesterday into today better, right? Um, uh, Powell hawkish, just when it felt darkest, Microsoft and Meta came to the rescue. The AI cloud demand narrative is now indisputable, right? That's your first part there. And we know that Powell came out pretty hawkish yesterday. And then this is what I thought was super interesting here, and we're starting to see it in the numbers. I took note of Adidas yesterday that warned it may hike prices in the United States after tariffs added 200 million euros to second half costs. And then highlighted here from Goldman, price pass through is back on the radar. August inflation might be interesting. And that's kind of what it comes down to. This is why I have been trying to pay such close attention to some of these companies on what they're saying around tariffs. And that's what Adidas just said. We just saw Procter and Gamble report earnings the other day, and Procter and Gamble said, like in over the course of the next month, they're expecting that they're going to increase prices on about 50% of their goods because of tariffs. That's what Procter and Gamble said. And Procter and Gamble, again, they're making your soap, they're making your toilet paper, they're making your shampoo. They're making the items that every household is impacted by, and they're predicting that 50% of their products are going to have an increase in cost. Walmart has already just started to do it. So when you circle back on this market here, in my opinion, it's still to be seen on if the event-driven market turns into a cyclically driven bear market, which means that the economic numbers deteriorate. Does the tariff event lead to economic deterioration? Does it lead to a slowdown in the economy coupled with increased inflation? Basically, tariffs, we have hundreds of years of data that show us this. Tariffs have a stagflationary impact on markets, but how bad is it going to be? That's the other question that has gone through my mind, which is, all right, I know because I studied economics. I'm pretty educated in this area. I consider myself to be a little bit of an expert on it. I know that tariffs have a stagflationary effect on the economy. But how bad is that impact? And is everything else going just so well right now in the economy that it can override that? The big beautiful bill is going to increase deficit spending, but increasing deficit spending, that tends to be good in the short run for the stock market. And the AI boom, right? Are the efficiencies coming from the AI boom that could be potentially more than enough to counter the negative impacts of tariffs. Where, maybe I got in my head too much about the negative impact of tariffs and I wasn't thinking enough about the positive impacts that this incredible revolution that's ongoing right now for society is actually gonna happen. Um, so, that's kind of all to be seen even still now. But what we have started to see a little bit slowly in the data is little upticks in inflation now that are directly tied towards tariffs. And when you look at Adidas, Procter and Gamble, Walmart, a lot of these types of companies, the car companies, they have only begun or have not yet even begun to pass through prices related to tariffs. I know Brant was just talking about this on the radio the other day. He was saying to himself and explaining it to all of you. I was really racking my brain trying to figure out, like, is there a scenario where tariffs can be good for markets? And his conclusion is the same conclusion as mine, which is no. Tariffs have to do one of two things. They either increase price, and then we see, supply and demand, right? When prices move up, there's potentially less demand for those products. But we have to see, one thing you can say about the consumer. The U.S. consumer has been extraordinarily resilient, and we know the U.S. consumer loves to spend. Those people out in Long Island, Josh Leffler's neighbors over there, um, they're gonna try to keep up with the Joneses until they're coming to take that car away from them. That's just how the American people roll, right? So they're gonna do everything they can to just continue to spend and continue to spend and continue to spend and go into debt, and that's just how the American consumer generally is. So you might not see an immediate impact on demand. They might just continue to buy anyway, but in the long run, it'll hurt the coffers of the consumers, and they'll run low on money. And then eventually, when you start to run low on money, then you have to make decisions, right? Should I get the slightly cheaper car? Should I do the cheaper vacation because I still need to be able to buy food to be able to put it on the table? The consumer is not at that point, right? And you probably need to see an uptick in inflation to not an uptick in unemployment to really also impact that, right? The unemployment's the other big one. So one is you're going to get an increase in price. The other thing that companies can do is is have worse margins on their products, right? Instead of making a 100% margin at Procter and Gamble on that bar of soap, they absorb some of the impact of tariffs, pass through some of the impact on tariffs, and now they have a 50% margin on that bar of soap. But that impacts the bottom line. And what will companies do in that situation is they're going to try to be as efficient as possible, which turns into layoffs, I think. So margin compression for S&P companies will obviously hurt the stocks themselves, but in order to minimize margin compression, you're going to reduce hiring and potentially let people go. And it's interesting because that happens at a time when the AI revolution is occurring. I was just talking to a friend that I went out to dinner with two nights ago. He works for Deutsche Bank, and he was complaining to me about having to teach like an entry level analyst. Oh man, it was something related to interest rates on bonds, and I really don't remember exactly what it was, but I just remember how frustrated he was. First thing he said to me as soon as I saw him was like, "Man, I need a drink." I couldn't get through to this analyst about the difference between whatever it was related to interest rates. It was a relatively simple concept, right? And and immediately I'm asking him, I'm like, "Well, do you think that instead of teaching that entry level analyst about interest rates, that you could have just had AI do it?" And he said, 100% without a doubt. So, the interesting thing is, we might be seeing tariffs have margin compression for these companies which therefore makes them want to do layoffs right at a time when there's another option for them for a lot of the more menial tasks, which is robots, which is AI. And the biggest or worst, I guess I should say, read through that I think could happen in the market is you really start to see unemployment pick up. Like that's the biggest thing that I'm looking for. And I know we talked about this a couple meetings ago. And PMD Trader had some great points about interest rate cuts as unemployment increases. But the worst thing that can ever happen to an economy, and this is just what to me why this whole tariff situation is just so crazy. The worst thing that can ever happen to an economy is if you have prices increasing and unemployment increasing at the same time, because the Fed has a dual mandate, price stability and maximum employment, and the Fed has a ton of tools available to them to help them achieve that dual mandate. But pretty much all of those tools have opposite effects from one another, right? If you are implementing a tool um, that can reduce inflation, those same tools reduce growth. That's what we just saw in 2022, right? 2022 was so incredible because we did go into a bear market. The bear market was not nearly as deep as many analysts were expecting, but we had to go into that bear market, right? We kind of created this bear market because inflation because due to supply chain issues related to COVID went up to 9.1%, and we had to get it back down. So they jacked interest rates through the roof to reduce to reduce inflation, but the impact of that also is a reduction on growth, and that's what led to the bear market in stocks. But it was a necessary evil. You had to do it to bring inflation down. And then you fast forward all the way to the end of 2024, and you're finally hitting the point where victory is announced. And in my opinion, and this is why I still give Jerome Powell, he's not perfect. I give him so much credit. The fact that he was able to bring inflation down from 9.1% to 2.5% without creating a long lasting recession. I think we had like two negative quarters of GDP in a row in 2022. And I think one of them was then revised to actually being a positive number. He was able to bring inflation from 9.1% to almost 2% without creating a recession. It's unheard of in like the history of economics. So I will always give him a tremendous amount of leeway and a tremendous amount of credit because he was able to do that. Now I do think that some of it wasn't 100% because he pulled it off. Some of it was just a stabilization of the supply chain economics that created that inflation to begin with that was related to COVID. But overall, the fact that we were able to do that was incredibly impressive. But that's an example of, all right, well, the economy is doing really well, inflation's out of control. I need to slow down the economy to be able to bring inflation down. So you got tools that can do that. You also have tools where if inflation is not out of control, if inflation is where it's supposed to be, if inflation is low, but the economy is not doing well, you have tools that they can use that can stimulate the economy and that tend to be inflationary in nature. So you get a little bit of an uptick in inflation, but it's going to really help the economy. So those are the types of tools that the Fed has. But when all of a sudden the economy runs into a situation where inflation can move higher at the same time as unemployment can move higher, you're in a real pickle for the Fed because whatever tool you're going to use is going to make one side of the mandate, which is a problem, already worse. So I have found it interesting, and I think it's the right idea. We saw Jerome Powell not yesterday, but in a Fed meeting, like a meeting or two ago, in the Q&A, basically say that if that were to happen, he basically said that I think that price stability is more important. I think his direct words were price stability is a necessary component to having maximum employment. The read through on that to me was if you saw inflation getting out of control, but you also saw unemployment spiking, that he's going to focus on utilizing tools that are going to bring inflation down first, which that can significantly increase the growth slowdown. but it makes sense to me, right? Like that commentary makes logical sense to me. How can you have a good employment situation if you don't have price stability? So price stability is probably going to be number one in a situation where both happens at the same time. But we haven't seen a stagflationary environment for the U.S. economy in a very, very long time. And tariffs have the capacity to be able to do that. But we haven't seen it in the data yet. And we don't know how bad it's going to be. I circle back to what I was saying before. Like, maybe it's not that bad, right? Because S&P companies have higher margins than they've ever had before. And you have AI coming along that's going to be able to increase those margins even further. Um, and maybe you get a one-time temporary uptick in inflation that's related to tariffs, but it comes right back down, in which case it's not going to be necessarily the end of the world. And you see unemployment pick up a little bit, but then he can cut rates and stimulate because the tariff increase on inflation was just a one-off, and it comes back down, right? Maybe that's what happens, or maybe it really does turn into a disaster and the market retests April lows because inflation's getting out of control and everyone is firing everybody to try to maintain margins and replacing it with AI and robotics. I don't have a crystal ball to be able to answer that at this point in the future. But it's all kind of lining up here as far as I'm concerned. Um, bad tick on Palantir. It's all starting to line up here as far as I'm concerned, where when you look at Adidas, you look at Procter and Gamble, you look at Walmart, you look at the PCE this morning, which the PCE was very, very slightly hot, and the unemployment number was low. So it circles back to what Jerome Powell said yesterday. He basically said, like, the unemployment situation is great. um, we're basically at maximum employment, but inflation is still a little bit higher than it's supposed to be. So why am I going to cut? I need to have the economy and interest rates be a little bit restrictive right now to try to get inflation to come back down a little bit further. And I don't have to worry about the employment side of my mandate because it's intact. The really interesting part about the employment side of the mandate that he discussed yesterday was, I really thought this was fascinating. I love listening to Jerome Powell. He's just such a smart guy. Um, I really thought it was fascinating. He was talking about, like, there actually has been a deterioration in the employment situation in terms of, like, less jobs being available, but it's happening at the same time that there's less people looking for jobs. I think the read through on that is our immigration policy here in 2025, where obviously we're getting rid of a lot of people in the country who are here illegally, but those people who are here in the country illegally were doing a lot of jobs. But you're seeing jobs come down, which is a sign of some degree of early economic contraction, but the Fed's mandate is maximum employment. So if there's less people looking for jobs, but there's also less jobs, it keeps it at maximum employment. And he described it as like something to pay attention to. Like there could be downside risks to the economy off of that. But for the moment, we're able to maintain maximum employment because you got less people applying for jobs at the same time that there are less people, there are less jobs. I certainly have a worry about the statistics about young people, like those numbers that we're seeing about recent college graduates, people in their 20s. You're seeing a big uptick in unemployment for recent college graduates and young people. That's a problem. That's a problem that China has had for several years now. I don't know what the solution is to that because I think that AI is a big problem here. It goes back to the conversation I just had with my buddy who works at Deutsche Bank 2 nights ago about do you really need that analyst that's giving you this huge headache and wasting all of your time? No, I could just hire AI to do it. But there's negative implications for that, right? Um, there's several. One is college graduates who, by the way, tend to be in a lot of college debt now can't get jobs to be able to pay those college debts. And I'm not talking about, you know, the person who decided to study uh, like ancient Greek as their major and then can't get a job because they studied ancient Greek. I'm talking about like actual people who studied economics and finance or fields that are supposed to lead to jobs not being able to get jobs because why hire that pain in the butt entry level analyst when you could just have AI to do it? Not only do you save on the headache, but you save on the salary. The downside on that is if you don't get young people in those offices and learning those basic skills, they don't grow into the senior management and future leaders. But companies aren't going to be thinking about, let me hire this analyst who's 22 years old right now. And, you know, someday this will be a person who is going to be our CEO in 20 years. They're not going to think that way. It's all, short-term profit driven. And especially in this day and age, people don't have any loyalty, generally speaking, to the companies that they work for. Like what you're supposed to do almost as a young person in a lot of careers is actually bounce from job to job to job. There's a lot of studies that show that that's the best, fastest way to actually increase the salary that you're receiving is by going from one company to the next and not having any loyalty. So, why are companies going to be hiring analysts and paying them 50 to $100,000 salaries for headaches when they can just hire AI to do it? So I'm very concerned about that aspect of the employment situation. I'm worried that, tariffs, if they eat away on margins, are going to have a dual effect of margin reduction in companies, which hurts the company itself, but also leads to additional layoffs, which increases unemployment at the same time that prices are increasing. And um, the most bearish thing that I think, and PMD Trader brought up a great point about if we see a pickup in unemployment, then we're going to get cuts in interest rates, and that's going to be bullish and stimulative. And he's generally right, I think, as long as you don't see the big uptick in inflation with it. But the worst thing that could happen in this stock market, the thing that could get us below April's low and put us in a genuine, real bear market, is if unemployment really picks up and you're getting an inflation pickup at the same time so that you get all the negatives of higher unemployment. And the biggest negative to the stock market, by the way, of unemployment is you lose the retail bid. The retail bid, as we know, there's so much data on this in 2025, has been unstoppable. Retail is buying the dip, they're buying highs, they're buying options, they're buying meme stocks, they're trading, they're investing, they're smarter, they know about dollar cost averaging, they know about I was having friends reach out to me in April who are not necessarily financially literate and being like, "Hey, I see the stock market's down a lot. Should I start buying it?" And it's like that's not how retail of like 2001 thought of things, right? Retail in 2001 was like, "Oh my God, panic, 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 panic! The stock market's going down." Honestly, retail in 2008 was the same way. "Oh my God, panic, panic, panic! Sell everything. The stock market's going down." Um, I remember in 2008 speaking to one of my father's friends, and I didn't really know a ton about markets and economics yet, but I remember it very vividly. We were basically at the bottom in 2008, and one of my dad's friends goes to me like, "Oh, what do you think about the stock market? Like, I kind of think cash is king, and I shouldn't have any stocks." And that was at the absolute bottom of the stock market. I don't think retail thinks that way anymore. Um, I think that they're more educated. But if they don't have the money to be able to buy the stocks anymore, that's when you lose the retail bid. And they're not buying the stocks if they don't have jobs because all of a sudden they got to think about, hey, I'm not buying the Apple dip. I got to go buy groceries. And if you have an uptick in inflation at the same time where the Fed can't be as stimulative as they would be otherwise, that's the ultimate combo that and look, I'm not a doom and gloom guy. I really never have been. I'm just putting out possibilities. But that's the ultimate combo that gives a bear market like the modern generation has never seen, right? Like COVID was a blip. Um, April was a blip. Uh, a real bear market is like second half of year 2000 through year 2005 or 6. Like that's a real bear market or to some degree the financial crisis. And there was I graduated from college in 2008, right? I was trying to find a job during the financial crisis, and what did unemployment reach at its worst in the financial crisis? 20% or something. I remember at one point struggling to find a job and being like, well, I'm just like, one out of every five people that want to work. Not even, doesn't even include the they don't include the people that they consider to be discouraged workers in the employment index, right? So all food for thought. As of today, we made all-time highs in the morning and then closed on lows. So we'll see. Is this a distribution phase? We'll see the non-farm payrolls number tomorrow, which is going to be for July, but I don't think that number will have any tariff impacts in it even still yet. Um, Circling back to that Goldman note, August maybe is when things are going to get interesting based on what these companies are saying. And it's going to be a slow knock-on effect of the degree to which tariffs impact us, which is yet to be seen. I said it twice already. Maybe it's really bad. Maybe it's not so bad because we have other things that are going so well for us at the same time that can help to offset it. I genuinely do not know. I don't even know how I got going on that, but whoever asked the question, I appreciate it. And that's it. I think that was off Mike Reed's question. So thanks for setting off a rampage there. Um, from Liam, I'm moving into a new place in Charlotte and thought it was interesting to have all their Halloween stuff out in these stores. Halloween stuff. All the tariffs got them ordering all the Halloween and Christmas items and putting them on the floor. The lady said they've had Halloween out since May. It was just interesting to see that impact in person. That is interesting. Yeah, the consumer is spending. MSTR is out. Ray Dalio sells his last stake in Bridgewater. Floodwaters strand multiple vehicles. A state of emergency is declared for heavy rain in New York City. From Eli, by definition, didn't we see two contractory GDP numbers when Powell was tightening, which technically does imply a recession? Yeah, so my definition of a recession has always been 2 quarters in a row. This is what I was always learning in college. They've been trying to change it and say it's up to a board or something like that to actually declare it. As far as I'm concerned, if you see two negative GDP prints for 2 quarters in a row, that is a recession. That is the definition of a recession. How long does that recession last? Maybe it only lasts 2 quarters. Maybe it lasts 2 years. In 2022, when Powell was tightening, we did see that. We saw 2 quarters in a row of GDP contraction, which is my definition of a recession. But as you probably know, um, a lot of the time those numbers get revised, especially like in employment numbers. I think about it. Tomorrow. We have non-farm payrolls for the month of July. Tomorrow is August 1st. How can they so precisely know the non-farm payrolls number for July by August 1st? Do they really know about your friend that just got laid off at 4 p.m. today for non-farm payrolls number? You know, so the answer is no, right? So that's why you see revisions go out. And fact check me on this, but I'm pretty sure that one of those 2 quarters of negative GDP in 2022 actually was revised to like very, very, very slightly positive, which therefore means that we never actually had a recession in 2022, which is so incredibly impressive. From John, this is part of innovation as destroying things. Yes. Yeah. So, I mean, I think throughout time, you have seen periods where people talked about how innovation was going to destroy the economy or destroy certain aspects of things. And we've obviously always evolved, right? You can, I don't know, look towards, I don't have any good examples off the top of my head, but like when we went from horse and buggy to motorized vehicles, well, all those people that were responsible for maintaining horses lost their jobs. Um, so you could easily make the case that AI is just the next revolution. It's going to hurt some people. It's going to benefit other people. My concern is that AI is a revolution like we've never seen before, and maybe I'm just being a doom and gloomer and I'm wrong on this, but it seems to me like the impact of AI, based on the way that Satya Nadella and Mark Zuckerberg are talking about it, is going to be so revolutionary that, I mean, it's not like you're just impacting the jobs of people who used to work on horses. You're impacting every sector in the entire economy. We don't need cashiers anymore. We don't need taxi drivers anymore. We don't need entry level analysts anymore. We don't need actuaries anymore. We don't need. Um, so like that's the interesting thing about AI is compared to I think other periods of innovation is I don't know if you've ever seen something that is so disruptive to basically every industry that I can think of in the history of the world. But, time will tell. Um, there will be some people that benefit, and I think that there's always going to be room for us physical traders too. I still think that too. From Eli, don't you think it's kind of ridiculous for them to put the numbers out in the first place? Then what's the point if they're going to revise it? I don't know. I want to say yes. It seems a little bit ridiculous for them to give us a non-farm payrolls number tomorrow when we know that it is probably going to get revised. But what then? What's the right way to do it? What's the better way to do it? Do we wait 3 months for numbers? By then the numbers are so stale that they're useless. Right? If I gotta wait for 3 months to know exactly truly what the July number was, it's going to be completely useless by then, from a data input perspective. So I'd rather them give me their best possible shot of a number tomorrow, and then I've got a general idea of how things are trending and looking, and then we can pay attention to those revisions over time. From Liam, the no new jobs thing is very real. Before I took this job at T3, I was looking at financial analyst roles in Charlotte, and there was maybe 2 or 3 jobs, and none of them in major banks. In school, they always talk about any new invention that people think will destroy jobs actually creates jobs, but AI is very different from the dishwasher or the radio. Yeah, yeah, yeah. That's where my head's at too. Yeah, but I don't, Eli. They revise it, but I think that I think that's it's generally kind of close-ish. The number is going to get revised, but if most likely tomorrow is a major miss, it's not probably actually going to get revised to a major beat, right? It might be a little bit worse or a little bit better than what we see tomorrow, but I don't think that those revisions tend to be like so massive that I still think that you need to know the number. Let's see what's going on in YouTube on my rant. No comments in the YouTube today. Wow, look at that. All right, cool. So I'm happy to wrap it up there because that was a long one. We got into some pretty deep discussions. Take a quick look. Apple, how we doing? Apple is up $1.50 now after hours, so not going to be too helpful for this market. Amazon is trading down 7. The spies are trading down 40 cents, so basically nothing. Spies are down very, very small from the close. Qs are down 70 cents from their close. Also not too big of a deal, but maybe we're going to actually have a gap down tomorrow unless non-farm payroll saves us. Have a great night, everybody. I'll see you tomorrow.